Here is the mistake most salaried employees make. You compare the old regime and the new regime like they are belief systems, and then you choose the version that sounds smarter in office conversations. They treat the regime choice like a badge, not a calculation. But your payroll does not care about your opinion. It only cares about slab rates, standard deduction, cess, and whether your real deductions are large enough to cancel out the lower rates in the new regime. That is why so many engineers get this wrong. You might spend hours optimizing your cloud bill or comparing laptop configs, but when it comes to tax, you pick a regime from a WhatsApp forward and move on. The Income Tax Department says the new regime is the default option, according to CBDT guidance in 2026, but default does not automatically mean best for you. What matters is the gap between what the new regime gives everyone and what the old regime rewards only if you can actually claim enough deductions. Start with the big update from the Press Information Bureau in 2025. Under the new regime, salaried people can pay nil tax up to 12,75,000 rupees, because the standard deduction pushes taxable income down to 12 lakh rupees. The standard deduction itself is higher in the new regime. It is 75,000 rupees there, versus 50,000 rupees in the old regime. Then look at what the slabs actually do. The new regime keeps income up to 4 lakh rupees at nil, then taxes the next band at 5%, the next band at 10%, then 15%, then 20%, then 25%, and then 30% above 24 lakh rupees. The old regime starts taxing earlier. It gives you only 2,50,000 rupees before tax starts, then moves to 5%, then 20%, and then 30%. Both calculations also add health and education cess of 4%, which people often forget when they do rough mental math. So let us stop arguing in abstract and use real salary cases. Take a salary around 12,75,000 rupees. Under the new regime, the tax is 0 rupees. Under the old regime with no old only deductions beyond its own standard deduction, the tax is 1,87,200 rupees. That is a straight gap of 1,87,200 rupees. That matters, because a lot of salaried people still assume the old regime is naturally better at lower incomes. After the 2025 changes, that assumption can be badly wrong. Now move to a more typical software salary of 18 lakh rupees. Under the new regime, this salary leads to tax of about 1,50,800 rupees. Under the old regime without extra old only deductions, the tax jumps to about 3,51,000 rupees. So the old regime costs roughly 2,200 rupees more in this example. For the old regime to merely break even here, your deductions and exemptions that are meaningful only in the old regime need to reach about 6,41,700 rupees. That is where most people get surprised. They are nowhere close to that number. Unless you have serious HRA exemption, meaningful home loan interest, and a full set of eligible deductions, the new regime is usually doing more work for you than the old one. Now push salary much higher to 30 lakh rupees. The new regime tax keeps rising, of course, and in this case it becomes about 4,75,800 rupees. The old regime without big deductions rises to about 7,25,400 rupees. And the break-even deduction number climbs to about 8 lakh rupees. That tells you the real rule. At mid to upper salaries, the old regime wins only when your deduction stack is genuinely heavy, not when you just like the feeling of claiming things. The CBDT Tax Tools page is very clear on this logic. If you have no deductions, the new regime is more beneficial. If you do have substantial deductions like HRA, Section 80C, Section 80D, or housing loan interest, the old regime can become beneficial. That is the entire game. Not emotion. Not habit. Just deduction size versus rate advantage. So how should you decide this in real life? Start by listing only deductions that disappear or matter differently outside the new regime. HRA exemption is the big one for many salaried employees. Housing loan interest on a self-occupied home can matter. Standard deduction is not your differentiator anymore, because both regimes give it, just at different levels, so do not count the standard deduction twice. Then compare that list with the break-even zone for your salary. Around 16 lakh rupees, you need roughly 5,68,800 rupees. Around 18 lakh rupees, you need roughly 6,41,700 rupees. Around 24 lakh rupees, you need roughly 7,87,500 rupees. And around 30 lakh rupees, you are looking at about 8 lakh rupees. If your total is clearly below those numbers, stop romanticizing the old regime and pick the new regime. If your total is clearly above them, the old regime deserves a serious look. If you are close, run both calculations with your actual payslip before you submit your investment declaration. Then make the payroll choice and revisit it again before filing the return, because your payroll estimate and your final tax position are not always the same thing. Because salary components change more often than people admit. Rent changes. Home loan interest changes. Bonus structure changes. Some planned deductions never happen. Some people forget that the regime choice they made in payroll was based on January assumptions and not March reality. The smart move is not loyalty to a regime. The smart move is a calculator, a spreadsheet, and enough honesty to admit that the best tax regime is just the one that leaves you paying less. If this cleared up the regime confusion, subscribe to WealthCode. We break down India personal finance with actual math, not tax folklore. We are going to break down how EPF, PPF, ELSS, and NPS actually fit into a sensible tax saving plan.